Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending March 17th. Saw some strong price action to the upside in the cryptocurrency space and ultimately saw most markets head higher as well as the government stepped in and guaranteed depositors all of their money from the banking collapse that occurred the previous week. I think if that had not occurred, we likely would have seen markets head lower, but they did step in and guarantee those deposits, which ultimately I think saved the markets from some pain over the last week. I don't necessarily agree with that move, but it is what it is, and it happened. So I think ultimately that's one of the biggest catalysts sending asset classes higher on the week. And because they have done that, I think there's a pretty strong chance that the Fed's going to have to back off their 50 basis point rhetoric. And I think there'll actually be quite a few factors that could ultimately send the market higher. But as we're going to see, diving into these charts, there are still some concerning signs in some of these charts that we watch. So we'll dive into those and take a look at what we're seeing. Starting out with the Bitcoin chart, sitting at about 27,500 as we're recording this. We saw a real strong move, breaking up above that 25K level, which was a really significant level that I was watching for. It looked like we were going to potentially break out of those levels in February, but we ultimately broke down, and that acted as pretty strong resistance, as it has many times. Really, we haven't been above these levels since June of 2022, but a real strong move to end the week on Bitcoin, and it looks like we're heading higher from here. However, we do have our anchored VWAP from our all-time high and a Fibonacci extension level supported with quite a bit of volume, support resistance, kind of sitting at this 30,000 level. So I think 30,000 is going to be kind of the next area to contend with for Bitcoin, but I do think we get up and at least get to these levels and test those. Wouldn't be surprising to see a little bit of consolidation at this levels, or maybe even a bit of correction off the 30K, but it does look to me like we're ultimately going to head higher than that for Bitcoin, and my next upside price target once we clear the 30,000 range would be this 35,000 level, which would be a wave 3 to the upside for Bitcoin. Jumping over to the Ethereum chart, we do have our all-time high anchored VWAP sitting at about 2K on Ethereum, so I think that's likely our next upside price target to shoot for on Ethereum. But I do think we can ultimately head higher from there, but we first got to contend with that 2K level. And then when we take a look at our total cryptocurrency asset classes, we are now well above the 1 trillion level once again. We had a pretty significant breakdown off those levels not too long ago, but we saw a real strong reaction off of that sell-off and just rocketed right back to the previous highs that we had in February, and now we're once again even higher, sitting at about just under 1.15 trillion for the cryptocurrency asset class. And then we take a look at our traditional markets, jumping over the S&P 500. S&P did move up on the week, but not quite as aggressive as we saw in both Bitcoin and the NASDAQ. But we did see some constructive moves to the upside as we got back outside of this descending trend line. We also came back down and retested that level on Friday, and we did hold that as support. So as long as we can hold that as support, that could be a promising sign for the S&P 500. But we do have some really strong volume resistance to contend with right around this 395 to 400 level on the SPY. We see price action clear that, then I think that would probably be an all clear that will likely see price action head higher. That's also right around our 50-day moving average on the SPY. So we've got a little bit of upside resistance to contend with still, but it is promising to see us kind of close the week out above that trend line, which we've been stuck below for all of last year. And then we take a look at our breadth measures for the S&P 500. Also an area where we need to see some improvement. We're below the 50% level on stocks above their 200-day moving average, sitting at about 39%. And we also saw a massive collapse on the S&P 500 stocks above their 50-day moving average, drop all the way down to, at one point it was about 17-18%. We've moved up a little bit now, and we're sitting at about 20%, but that's still a pretty big drop, whereas if we look at towards the end of last year and end of November, we were sitting at about 92% stocks above their 50-day moving average. So definite significant decline here, but hopefully we can start to see that resolve, and if we are looking for the broader markets to move higher, we definitely need to start to see some improvement in our breadth measures. Then take a look at the NASDAQ chart. Definitely looking strong here. We saw a big move on Thursday on the NASDAQ, and then ultimately closed the week out with a nice retest of this 303.75 trend line, and ultimately held that as support. but we also are contending with this anchor VWAP, which it tested as well and did not break through. So kind of trapped in between this 303 and 309.50 right now. I do think the most likely outcome is we continue to hit higher from here. Our next upside area of resistance is this 316, 317 level on the triple Qs, which is our anchored VWAP from the previous highs. So those will be a couple of key levels to break through. If we can see some follow through above those levels, then I think that would likely set us up for even a bigger move to the upside on the NASDAQ. I think we'd be looking for the next upside price targets at about 330 or 340. So we could see a pretty nice move on the NASDAQ coming up. But we do have a couple of pretty significant anchored VWAPs to contend with in the interim. And then we take a look at the Dow Jones Industrial Averages. We are below our 200-day moving average, which is definitely a clear breakdown in the Dow, as we've been sitting above our 200-day for some time now. We broke above the 200-day back in November of last year and had held that as support ever since. And so seeing a breakdown below those levels is definitely not a bullish move. However, we did hit this anchor VWAP off the COVID lows, and that looks like that's potentially holding us support. So as long as that 316 on the DIA holds, I think there's reason to hope that we do put in a bit of a base here, and then ultimately head higher. And we want to see the Dow Jones Industrial get back above that 200-day moving average, which is currently at about 324. Take a look at the transports. Also need some repair as well, as we are now back below the descending wedge pattern as well as the 200-day moving average. So we're not too far below those levels, but we'd like to see the transports get back up above 14,000, and I think that would be a pretty strong sign if we can do that. But for now, we need to be a bit cautious on the transports as well. And another chart that we need to see some improvement on is our Russell 3000. We came down and got back down into this trend line that we were stuck in for all of last year, and we're also have now seen 2 weekly closes below our 21-week EMA and SMA levels, which is definitely not a bullish outcome. However, I think a lot of that kind of breakdown in the markets ultimately was based on the banking situation, and at least in the short term, it looks like that's been resolved with the government. And so as long as that continues, I think there's a decent chance we can hopefully repair this chart and get back up above the 21-week EMA and SMA levels, and also above this descending trend line. But for now, we're still below those levels, and again, we've got 2 weekly candlesticks closing below them also. So I think that's something we need to be a little bit concerned about and just keep a close eye on. And if we do not see the Russell 3000 regain those levels, then it's pretty hard to be super bullish for the markets right now. So we need to keep a close eye on that. Hopefully next week we'll see some fall through and we'll start to see the markets move higher, and we'll potentially get back up above those levels. And then when we take a look at our new highs, new lows list, we can see that we had a clear breakdown on our 10-day moving average to the downside, and we also saw an absolute collapse in our new highs, and we saw a pretty significant acceleration in new lows. However, if you look at just the last few days, we are starting to see the new lows decline a bit, but we are not seeing new highs starting to move back up. And so this is another area of concern that we want to see kind of correct itself. We want to see this line get back up above our 10-day moving average. We want to see new highs start to move to the upside and continue to see new lows head lower. So we'll keep a close eye on that, but those are a couple of key areas that we need to see improve before we get super bullish. And when we take a look at the Russell 1000, also another chart that needs to be a bit repaired, as we're now back below this descending wedge pattern, and we're also below our 50-week moving average, and we want to see that resolve to the upside if we're long large caps, and we're pretty much right at that key level. So we'll see if we can get some follow through next week. It won't take too much more price action to the upside on large caps. We see large caps get back up above about 220 or so on the IWB. I think that'll be a pretty bullish sign for our large caps. Take a look at the small caps, however. We saw a massive breakdown in February on the small caps, and we are now back below this descending wedge. We are below all of our major moving averages, and so definitely a pretty bearish look for small caps for the time being. However, we are at a key level right around 170 or so on the IWM, which was at the exact area where we bottomed out in December of last year. So we'll see if we're putting in a bit of a bottom here with a double bottom, and ultimately if we can see small caps get back up above this descending wedge, start getting back up above these moving averages, that'll be a great look for both small caps and likely the broader markets in general. But definitely have some damage to repair on the small cap chart right now. And then when we look at this chart in relation to large caps and small caps to see who's outperforming and who's underperforming, we can see when we're going up and to the right, small caps are outperforming large caps. And that was a pretty steady trend ever since May of last year. However, the last couple of weeks there's been a clear breakdown in that trend, and now small caps are clearly underperforming large caps pretty significantly. However, we are at this 0.79 resistance level, which has been an area where that's tended to reverse multiple times over the last few years. So we'll see if that can occur again, but for now, small caps are looking like a much worse place to be than our large caps at the moment. And when we look at growth versus value, we can see a massive move out of growth. Just looking back at this chart, you can see there's not too many weekly candlesticks that have this kind of significant move. So that's definitely an interesting move for our growth market. Obviously seeing Bitcoin outperform, we're seeing the NASDAQ outperform. And so growth is looking like a great place to be right now. And as long as we continue to see that follow through, I think growth is the clear winner here in the short term for our markets. And then we take a look at our bond market. Taking the top panel here is our TLT, our 20-year bond. A lot of bond volatility off that banking news. So we saw just a lot of big moves. Bonds typically don't move that aggressively, but we've seen some huge elevated volumes in that. And I think ultimately what's happening right now is we're just seeing a lot of people getting into the bond market right now. We're seeing a lot of people purchasing bonds, and I think we're getting pretty close to probably a pretty big bond breakout. I think because bonds had a pretty historic year to the downside last year, I think we're going to see the exact opposite this year. I think bonds are going to be an excellent trade. I've already traded them a few times this year, and just looking for that clear breakout above the 200-day moving average. We really haven't seen price action with even a couple of daily candlesticks close above the 200-day moving average. We have to go all the way back to, I think it's 2021. If we zoom back out here, we can see that basically end of December 2021 was the last time we were above our 200-day moving average on the TLT, and so that would be a pretty significant development in my view, and it looks like we are definitely trying to get back up above those levels. But we've also kind of put in a bit of a triple top at 109.50, so to be a bit conservative, a clear break above 109.50 would even be more bullish, but even seeing a few candlesticks close above that 200-day I think also would be a pretty bullish development. But we haven't quite got there yet on the TLT. When we look at the bottom panel though on our IEF, the 7 to 10 year bond, we did get a pretty strong close above the 200-day moving average on Friday. And just a couple of days ago, we also had a close above that as well. So 2 of the last 3 days, we closed above the 200-day moving average. So we'd like to see some follow through next week and ultimately see multiple days in a row stay above that 200-day moving average. And I think that'd be a pretty strong signal for the 7 to 10 year bond, and really looking for a clear break above the 100 level on the IEF. And I think if we get that cleared, then that's going to be a big move to the upside, at least get back up above 105 pretty quickly, I think. And then we take a look at our sectors that we're tracking. We can see at the top of the leaderboard, precious metals have been doing great. We're seeing really strong performance out of the gold miners ETF, the GDX. Also seeing some strong performance out of silver, up almost 10%. But then we're seeing growth sectors like ARK FinTech and ARK Innovation ETF up 7-8%. And then also some other sectors like semiconductors and communication services doing really well, up over 5%. At the bottom of this list, we saw energy beat up really hard this week, as we saw on the energy chart or the oil chart drop down to the 200-week moving average. Also seeing the stocks underperform as well, as we saw the XLE down almost 7, the XOP down over 8. Other sectors that were down on the week were solar, steel, financials, of course, metals and mining, all down over 5%. And then we take a look at our oil prices. We can see that we dropped down below the this bearish flag that we'd been kind of stuck in for quite a few weeks. Saw a really clear breakdown this last week and came down and retested this 200-week moving average that we've been kind of expecting for some time now. And so we're now down at this level. So the big question from here is this the bottom? Are we going to see it hold support here and potentially build out a base and then potentially head higher? Or are we going to see a continued breakdown in oil prices? Definitely not 100% certain on where the next direction is on this. I think energy prices tend to head lower in a more recessionary environment. I think ultimately energy prices are starting to price in that risk of recession, which I think most people are expecting later this year. But we also have a lot of kind of macroeconomic and geopolitical factors that I think would suggest energy needs to potentially at least hold up relatively well, if not potentially even head higher. So still looking for some potential energy trades at some point this year, but for now, this is not the time quite yet. But if we do see that 200-week moving average hold up really nicely and start to see energy prices reverse from here, that could be the signal to start going long on energy again. But we definitely need some more price action to develop to kind of get a better indication of where we're heading from here going forward. And then when we take a look at our CRB index, we saw a massive breakdown in the CRB. We've also been stuck in a range on our CRB index for quite a few weeks, and we've seen a lot of breakdowns below this 267, but then whipsawed back up above it each and every time. Well, this time was definitely different, and we saw some huge follow through to the downside. So looking for that 243 level to the downside in the CRB index, potentially lower. Wouldn't surprise me at all if now that we've seen this kind of breakdown occur, that maybe we see the CRB index really kind of fall apart, and maybe we go down and retest this 200-week moving average, which is currently sitting at about 211, 212 or so on our CRB index. But things are definitely looking like they're heading lower, which should be great news from an inflation perspective. And then we take a look at our precious metals. Gold had a big week, really moving to the upside. GLD closed out at about 183, so definitely seeing some strong moves out of our precious metal space, including when we look at the gold futures. We did put in, we looked like we were potentially breaking out of the previous highs that we put in at the end of January, but ultimately kind of closed the week out just at those exact levels, and so we're sitting at about 1973.50 on our gold futures right now. Things are definitely looking bullish for this space, though, so I don't think this move is completed. I think there's still going to be quite a bit more upside from here, and definitely bullish on precious metals at the moment. And then we jump over to the silver, taking a look at the SLV. We did close above our 50-day moving average, which is promising, closing out on SLV 2063. And then when we jump over to our silver futures, also closing out right at, or maybe just slightly above our 50-day moving average rather, and also at a pretty strong area of volume for both support and resistance at this 2250 or so level. So if we can see some follow through and get above that level, then that 2250 or so is a pretty strong area to, I think, trade off of, and kind of what should hopefully be a really strong area of support for silver going forward. And I do think silver is going to be hitting higher later in this year, and we might be seeing this big move sooner than later. Jumping over to our interest rates, we started to see interest rates really roll over pretty much across all time series. Taking a look at our 3-month, we're now sitting at about 4.36%, so a clear reversal and a pretty big breakdown there. When we take a look at our 2-year, also seeing a big reversal and a breakdown, sitting at about 3.85% on our 2-year. However, we are at the bottom end of this trend line here, so we'll see if that holds or if we continue to just see that roll over even further. And then when we're taking a look at our 10-year interest rates, we can see the 10-year is sitting at about 3.43%. We are below our 200-day moving average. I think it's pretty significant. Kind of had a 1, 2, 3 where we had 2 days where we closed below that, 1 day where we closed above it. So still kind of some uncertainty as far as that 200-day moving average, whether we're going to ultimately stay below that or if this is kind of an area we're just going to chop around sideways. But definitely over the more medium term, we've seen over the last few weeks, we've seen a clear reversal, and it looks like rates are heading lower from here. And when we take a look at our 30-year, similar story, although we are above our 200-day moving average, sitting at about 3.63%. And then we take a look at our Eurodollar futures. So when we look at this chart to ultimately get an indication as to where the Fed is likely pricing in the Fed funds rates, if we take 100 minus wherever the Eurodollar futures are, that gives us a pretty strong indication as to where those targets are. When the Fed started talking tough about a possible 50 basis point rate hike, we obviously saw this number roll down, and then at one point we were suggesting essentially about a 5.7, 5.8% Fed funds rate, but that quickly reversed, and now we are sitting above 95, suggesting that that rate is now under 5%. And so that was definitely a big reversal. I think a lot of that had to do with the banking situation, and I think there's a strong chance that we are not going to get back down to these lower levels, suggesting a 5.75% or higher Fed funds rates. I think we've likely put in a floor on those levels. And then we take a look at the dollar, the Dixie chart. Looks like we're chopping around mostly sideways, but it also looks like this could be a potential topping pattern here. So we'll see if this is just some sideways price action or if this is going to be a breakdown. Typically when the dollar's going down, that's usually supportive of higher stock prices, but it doesn't necessarily have to be that way. And we'll see if we do see any price action to the upside on the dollar. I'd expect probably a retest of that 200-day moving average of about 106, 107. But we wouldn't expect it to go much higher from there, and it wouldn't surprise me at all if we ultimately saw the dollar head lower, and that would definitely be a good sign, I think, for markets. If we're looking for markets to recover and ultimately start heading higher, hopefully we'll see a weaker dollar supporting that rally as well. And then taking a look at the high yield corporate bond ETF, the HYG. This is another chart that I think isn't necessarily damaged, but it's also not looking super bullish. As we can see, we've had a pretty clear decline for the last couple of months in the HYG, so we'd like to see that ultimately kind of find some support here, which is at a pretty key level right around 72, 73 on the HYG, where we ultimately have kind of bottomed out before. So we'll see if we can get a reversal going into next week and start to see the HYG head higher. I think that would bode well for the stock market bulls too, as this tends to be a pretty strong indicator of where the market health is at. And then let's take a look at our investment grade bonds divided by IEF, our 7 to 10 year bonds. I kind of illustrated this last week with a couple of interesting signals here. So our white line is our 13-week EMA, and our purple line is our 13-week SMA. And one thing I've noticed as I've been watching this chart closely and zooming back and looking at it over history is each time we see that 13-week EMA cross over the 13-week SMA, that's tended to be a really strong signal for a negative outlook on stocks. And so this is another reason I'm being a bit cautious until we see this resolve itself. We have not seen that cross quite yet, but if we zoom in on this chart, we can see that we are definitely trending towards that outcome. We saw a weekly candlestick close well below those levels, and we're seeing that 13-week EMA pointing straight at that 13-week SMA. So if we see a big move to the upside on this chart next week, it could certainly avoid that cross. But when we do zoom back out and take a look at it on a longer term time scale, we can see that each time we've seen these crosses, it's been associated with a pretty reliable indicator of markets ultimately heading lower, and not necessarily one for one where it exactly drops that day when it crosses, but in a pretty tight time series, we can see that each time we've seen this cross, we've ultimately seen some drawdowns. So this first time, or not necessarily first time, but I went all the way back to the Great Financial Crisis, and after we had that rebound, the first time we saw that was in 2010. We ultimately had a 16% drawdown. Then we had another cross in 2011. We saw a 20% drawdown on the S&P. And the next time was in 2012, where we had 11% drawdown. Then in 13, we saw a 9% drawdown. Then the next time was in 14, where we saw about a 15% drawdown. Then again in 18, where it was about 18%. Obviously, COVID was a big crash where we had about 35% down. We saw that cross right before the COVID crash. And then we also saw that towards the end of 21, when we obviously rolled over and had a pretty rough year in 2022. That was represented about 28% down in the market. So this has been a really strong signal indicator for our overall market health. And we are, as I said, fast approaching a potential cross here. So a cross has not happened. We don't need to panic quite yet. But things are looking like if we do continue to see the price action stay below these levels, there's a pretty decent chance we could see that cross. So this will be a chart that I'm going to be watching really closely over the next few weeks to see if we can get a reversal and ultimately avoid that cross, or if we ultimately are going to see that cross occur. If that cross does occur, then I'm definitely going to be much more cautious in the markets going forward. And then we take a look at our put-call equity ratio. We are sitting below 1 once again. However, the previous week we saw a massive spike where we got up to just almost about 1.5, so definitely a massive put buying influx into the market, and that obviously was tied to the banking situations that occurred Obviously, after the government stepped in and did what they did, that kind of helped calm the markets, and then a lot of those puts kind of got sold off, and we are now sitting in kind of a more normalized levels to finish out the week. However, we are seeing a elevated VIX spike. We obviously saw that spike on that banking news, but we would think that if everything was kind of in the all clear, we would have likely seen that VIX at least got below the 25 level. We did close the week out above 25, which I think is also a bit concerning. So we'll see if we can get back down below the 25 level going into next week. And let's go ahead and close out the week with a trade opportunity. So we talked about Bitcoin looking like it was looking really strong and could see some more upside momentum. But when we take a look at Mara, ticker MARA, it is a crypto miner, and as we can see, it's been really stuck in a descending wedge pattern going all the way back to November of 2021. So it's been a pretty tough bet to the upside unless you're trying to pick these bottoms and get these kind of bear market rallies. But now we are clearly above those price levels or that trend line level. So we saw a close on Thursday to break that level, and then we ultimately saw on Friday a stronger move to the upside, and then a lot of that came back down and just about retested that level, and ultimately put in a bit of a hammer candlestick and gave up or recovered most of those losses on Friday. So things are looking pretty bullish. Also seen some really strong volume out of Mara, and so I think there's a real strong possibility that Mara is going to have a nice move to the upside. And if we use Elliott Wave math to kind of try to pick our next upside price target, looks to me like we're looking at about 1560 for Mara, and breaking off of that wedge there, that would represent over 100% upside off this trade. So as long as Bitcoin's above 25,000, I think Mara is going to be an excellent trade, as well as some of the other crypto miners for some nice upside in an otherwise kind of uncertain and volatile market right now. So thanks for tuning in, and make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto, and you can check us out at ToroAlerts.com.